following is an excerpt from an askSlim premium level video. Follow us on YouTube, give us a thumbs up if you like this video, and do subscribe to this channel on YouTube. Share it. There's tons that come out every single week. Follow us on Twitter at askSlim, and write to Matt at askSlim.com for trial memberships. We have trial memberships available for all of our levels, 1, 2, 3, and 4. And go to the askSlim.com website for details. Thank you, and enjoy the video. So now we're going to look at the stock market. Stock market having a nice 2.7% up day today. S&P's, that's the future. The cash is up about 2.36 as we do this. 63 points to the upside on the cash index. The NASDAQ, a laggard in here, up about 1.7% right now, and the Russell leading the way. We've seen that happening in the last couple of days. Those of you that are using our stock index report live stream, you noticed today how the Russell turned up before anything else did on those charts, and that reversal scout just signaled that happening. So take a look at that if you haven't seen that. What we're going to look at in here is the S&P 500, the Russell, and the NASDAQ. And as I said, we have kind of lifted the expected ranges a little bit as the market is in this consolidation period. So you can see here's the weekly chart, 3 weeks off the bottom. It's not very likely that that the third week off the bottom is going to be the best levels. It's pretty likely it's going to go up more than that. Crashes generally correct for some period of weeks and then begin to turn down. And as a matter of fact, you can see the way we have this analyzed with the minor cycles in here, that it's likely that this will go out for many, many weeks in this range that we talk about, and then before it accelerates to the downside out over here. Now this shift you can see in here where the low came here instead of what was expected here of about a month's time, that pushes this out by a month to the expected bottom time frame. So May to August now is the next period of very significant risk, with one little potential of a pretty good sized decline right over there. So yeah, I think we're in a bear market. I think we're in a crash. I think we're in a recession that is going to be somewhere between 2008-9 and the Great Depression of 1929 to 39 to 41. Somewhere in that level is where we're going to be. It's going to be pretty hard to get a real stock market that has any significant gains. I don't care what the Fed does. Everything that they have done has created a false market, and that's why you had a 35% decline that you're looking at right there on the screen. COVID didn't make the market go down. COVID triggered the market that was at risk, and that's what you saw happen. Now, here where you can see right now, we have slightly upgraded our ranges. We had the range, this was the range we had before, but now as we make higher highs right there, then the range comes up as the support zones come up. So it moved up slightly. We're showing you both cycles in here, the shifted cycle and the non-shifted cycle. It doesn't really matter. It gives you the same thing. It just makes it about 4 or 5 days apart from where we think that decline, that low would be. Excuse me. Resistance area here now between 2765 and about 2792. That's the area that we think it's likely to be able to get itself up to during this period. That's the top of the range. The bottom of the range somewhere over here, if it was really positive and this decline was really shallow, and it's possible because you see momentum neutralize right over there, and you can see the projection oscillator giving you strength right here as it can't get oversold. Those are signals that the market's improving right now. So the range is then moved up from this area up here, best level, maybe we'll just call it 2790, to somewhere here. This is 2540. This is 2470, and the bottom of it over here is 24. So 2400 at the worst case, a more reasonable 2470 to 2540 on the downside, and that's likely to come over the next 2 to 3 weeks right in here, and then set us up for another move into those areas right there. The longer this holds up in here, in this area, the more positive the situation is in here. Were this to hold up really strongly and not give a lot of ground, not be able to get much below these levels on a correction, we would then be looking at this level as a greater likelihood on the upside, about 29.40, out in this period before the next move on the downside. So this is, we let the patterns tell us what the situation is. Right now, the situation, because the intermediate pattern is only in its third week and turned up, you can see that right over here. I'm just really helping you with the multiple time frames. It says to us that it's very unlikely that the top is made in the third week. Because of the configuration right in here, it's very unlikely that there will be a break that takes you below the buy zone because of this upward energy that's going on here. That tells you that this next cycle rally phase will get you up here to these resistances, 2790, 2990, that's 2792, 2940 in this next area up here if this doesn't have any kind of a deeper decline. So it's all using the multiple time frames, and then after this rally over here, then you get into this period over here for a little bit steeper decline. So we're going to be using multiple time frames, support resistance areas, the shapes of cycle patterns, all for how we project this. And if you don't understand this, you can learn so much by taking our cycle workshop. I know that there are so many of you that have already, but using these multiple time frames and swing high, swing low analysis is a real key to really upping your level of profitability. So that's a deep look at the S&P 500.